Hello everyone, welcome back to Coin Bureau. My name is Jessica, and there has been a lot to unpack in the industry over the last few weeks, from evolving narratives surrounding CBDCs to infrastructure updates surrounding PayPal's newly launched stablecoin. We also saw Coinbase's protocol Base launch and the Curve exploit that got the whole of DeFi talking. Well, joining me to tackle these topics, I have Nitin Gaur, Global Head of Digital Assets at State Street. Nitin has really been a forefront runner in blockchain development. He spent 22 years at IBM, of which leading the global team as the director for IBM Blockchain Labs and Digital Asset Labs. Outside of IBM, Nitin also served as Portal Asset Management, specializing in digital assets and DeFi investment strategies. So, Nitin, what better person to speak about everything? How are you today?
I'm great, Jess, and really glad to be, glad to see you again. And I think last time we spoke, I was in Dubai. And this is happening, me being in Texas, you being in Dubai, and looking forward to all the pertinent current topics. Never a dull week in crypto. So
never a dull week. And I have to thank you as well. Crypto never sleeps. And we're currently operating on Texas. So it's very late with you. It's very early here in Dubai. So very appreciate the flexibility.
Of course.
But let's break down what we've seen in the industry. First of all, before we dive into the topics that we've mentioned, what have been some of these standout industry narratives that you've seen recently?
Yeah, no, I think it's a great topic. And last time we spoke, Jessica, we talked about AI and CBDC. And to me, there have been two broad themes that I've been focused on. And one theme is industry maturation. This is maturation of technology, both in terms of the technology stacks that drives the industry, shifting the narrative from speculative asset to more of a utilitarian asset, and focusing on utility. What is crypto trying to solve per se? The second thing is institutionalization, as you may have seen and heard from a slew of refiling of ETFs and all the regulatory challenges and the lawsuits that are ensuing in the industry. And then, despite all those commotion, you find the largest asset managers like BlackRock and ARK Investments as investment managers jumping in with ETF applications. And then you find PayPal, which we'll talk about in a few, with stablecoin. So you begin to see that crypto is here to stay. Digital asset is here to stay. And with, again, the convergence of crypto and institutionalization of crypto and digital asset, I think it's something to look forward to going forward as the technology matures. So that has been my underlying thematic sense: institutionalization, as well as technology maturation that is inching the industry forward.
So an overall kind of optimistic approach then. We'll dive a little bit more into some of the points that you said there. I do want to pick out AI first, because that was the first kind of buzzword that you mentioned. So AI and blockchain, I think we got mainstream attention on the AI front. I had a look on your LinkedIn, and you had an article which was how blockchain can enrich AI by bringing trust to data models. So two buzzwords there, AI and trust, two industries that can absolutely complement each other and really be transformative. Worldcoin did spark a lot of controversy in recent weeks. And as someone that is very kind of well adept in the AI space, what was your take?
So Worldcoin was interesting because I've been following Worldcoin. I actually was involved before I decided to step back from a lot of things they were doing, both in terms of understanding the ethical dilemmas of collecting biometrics, which is what you begin to see now in terms of some of the challenges in some governments, namely Kenya and Argentina lately. And again, dealing with issues like data privacy, I think all that needs sorted out. But before I go into the underlying model that Worldcoin has taken, which I think we in the industry have been socializing this for quite some time, Jessica, where the concept of universal basic income, which is ability for us to be able to monetize our identity and our data, and how can blockchain facilitate that exchange and ensuring that you have consent to and access to your own data. That is something Worldcoin is trying to solve. But let's take a step back. I think last time when we spoke in my article, I went a few lines deeper into the, exploiting the AI momentum, because post ChatGPT, a lot of innovation has happened and it's taken the industry by storm, to the point where blockchain has taken a back seat and AI has become front, right, and center of every concept, every conversation that we're having in the industry. But I've taken, at a technical level, a few assumptions in context of blockchain and AI. Blockchain is becoming the transaction and data platform of choice. So for business networks, whether it's crypto or whether it's public networks, and some of the efforts that are sort of transpiring in the traditional financial services industry using permissioned, which is private blockchains, and using the same technology but in a different context. Ensuring that blockchain becomes a source of trust among partners and various competitors that are actually transacting on the blockchain network. And then eventually using AI and network participants that are participating in these blockchain networks to gain insights and derived decisions that cannot be achieved alone. So AI-driven transactions will give rise to a new business model that we have begin to sort of socialize and begin to see a glimpse of that surface up in public networks. There are projects like YPredict or The Graph or Singularity.net have been looking into sort of having a decentralized approach to using AI and using the tokens, but underlying technology, which is using artificial intelligence and machine learning to process massive amounts of data and gain insights, is the theme that we're exploring. So broadly speaking, I have looked into two things, right? One is, what can AI do for this naturally linked data sets that blockchain bring? Can we then apply AI to bring real-time analysis, real-time fraud detection, real-time data analysis that is much needed, because most of the transactions that we process in blockchain are real-time. So this is application of AI and machine learning into this blockchain-based transaction networks to be able to provide the necessary framing and guardrails that's needed to ensure there are no nefarious activities happening, to find sort of business intelligence and insights into this real-time movement of assets. Because if you're moving the assets in real time, you need to have real-time visibility into all the functions that the business have gotten used to using a batch process that is the old way of doing things. The second model I'm looking at, Jessica, is looking into saying, what can blockchain do for AI? So a few things of AI, which again, Worldcoin is a perfect example, is trying to understand where is the trust in AI. And there's a whole element of explainable AI or XAI, which requires a lot of financial decisions that have consequences. For example, if I were to make a decision on your credit scoring and your ability to borrow funds, and if I'm using an AI modules, or if I'm using an AI model to make a decision on your behalf on your investments, then I should be able to explain that decision. I cannot simply blame an AI module. So in that context, we find that because blockchain provides that the trusted transactional model, can AI leverage that to provide the provenance of data, which is naturally native to blockchain? Can we look into linkability of transaction, which is also native to blockchain, and use an AI model to be able to achieve the ascertaining the data ownership? So I can ascertain the data belongs to you. I can build the trusted AI models because they do have certainty in terms of transaction processing and data transfer. The third thing I can do is I can embark on this XAI imperative, which is provide explainability to say I have this data and my model is supposed to evaluate these type of transactions, and these transactions are provable in blockchain. Ergo, the rationale behind a certain decision making that I have to go with it. So I've taken this intertwined element in my article and tried to expose the fact that this is not happening by accident. This is just an evolutionary process that blockchain generates enormous amount of data due to its transaction processing capabilities, and AI is a natural fit because they're able to consume the data, and they go hand in hand. And I see them as complementary technology as opposed to competing, which may seem like because of the fundraising and all the VC capital suddenly moving to AI. So it may seem like they're competing for resources, but to me, they complement each other quite well. So I'll pause here, Jessica, to see if that made sense.
Absolutely, it did. And you did spark my curiosity there, mentioning Worldcoin. I think just to go back onto that slightly, you did mention that you stepped down from involvement. Was that due to them, in your eyes, just not meeting the mark when it comes to being a trusted blockchain/AI entity?
So two things in this, right? One is AI, with all its potential, has its flaws like any other technology. And we have learned that from cars to, the whole seatbelt conversation we've had, that there has to be safety and guardrails around how we use and consume tech. And when we begin to deal with people's identity, which is tied to your biometrics, so generally you have multi-factor authentication, which is sort of the emerging theme of how do we protect your transactions and the way you interact. And generally you have an OTP and you have user ID and password. So it's generally who you are, what you know, what you have are some of the models that we have used. But if you get into applying artificial intelligence in storing and acquiring identity and storing identity and utilizing the identity to access things like your healthcare records, which is the core element of the UBI, which is the universal basic income, to say you as an individual can derive enough money because your data has value, and which today is not the case. Whether it's a developed country or developing nation, none of the the citizens can really monetize their healthcare record because either healthcare record is inaccessible to them, or it's been monetized by healthcare information service providers. So you really have no stake in that, even though it's your data. So the entire premise on UBI is that if our data is valuable, and we should be able to monetize it, and we should be able to provide consent. But the core element is acquisition of that identity. So if I'm utilizing my biometrics, iris scan, for instance, which is the globe that is acquiring your identity and then giving you a token. And while they were trying to attract some of the emerging economies because of the poverty ratios and trying to be able to generate that buzz and attracting a lot of people to be able to come on board and build enough corpus, which is enough data which fuels the entire model, I think we should take a step back and understand who's acquiring the identity, who's storing it, do they have the potential to misuse? Because at the end of the day, it can become a bigger problem, as we have seen with the tail end of the Web 2.0 journey, is the use of misinformation, disinformation, and massive identity theft that's been happening on the existing information dissemination platform, namely the internet. That's my concern, that we should step back, and just because we have access to massive amount of compute capacity, which is what AI is, it does massive computation. So we do have access to technology. I do want us to think about is to misuse and eventually the repercussions of that misuse to the populace that can be most affected. And the promise of the UBI, which is the intent, may really backfire, in which their identity is massively misused, and that can lead to all kinds of challenges as we can sort of extrapolate. So that has been my concern, is use and consumption of technology and understanding its limits, also understanding its guardrails that we need to put in place. So I'll pause here, Jessica, to see if that made sense.
And to bring it back to kind of regular people like me and you, people that are watching, we are seeing orbs rolling out around the world with incentivization, as you've mentioned, in regards to tokens in return for iris scans. People watching this that are thinking, I'd plan to go down on Thursday and Friday and claim some tokens. If you could give them one word of advice or just an additional piece of information, what would that be?
I would just spend some time in understanding what you're giving up and understanding who's actually storing this information. So while we are embarking on the narrative of decentralization, which leads to the fact that no one really has control of your data, but somebody is storing this information somewhere. And if that some entity has control, just understand there has to be your token that you're receiving, which essentially is an identifier to access to your biometric data. I think it's good to understand where it's stored, who's storing it, who has access to it. And while you may have a token in your wallet, that token may provide linkages to some system in the background that is keeping all your biometric information that potentially can be misused or linked to another token as a mechanism of nefarious activity or theft, and that could be detrimental. And it's good to understand one why you're doing it, and second thing is understand the mechanics of who is in charge and custody of your information that you're giving up for, I think.
And yes or no, will you be going to the orb to get the scan? No. Okay.
I'm not. Definitely not.
Me either. So
not yet. I need to understand this.
Understood. Well, thank you for that. I'm sure that's also cleared up a lot of questions for a lot of people that are wondering and kind of on that edge, that cusp of thinking they're part of new and immersive technology by taking part in something like this, but also not fully understanding what they're signing over. Okay, so plenty more to discuss. Now let's move on to DeFi, because I would love to pick your brains on the Curve exploit that we saw around 2 weeks ago now. The DeFi ecosystem as a whole really experienced some challenges. We started off with seeing a 6 $61 million exploit on Curve Finance pools. And these exposed more vulnerabilities across the DeFi projects as a whole. And it exposed what we like to call as a series of stress tests across DeFi protocols, DeFi pools. I'd love to understand and for you to break down to our audience the outcome, and also, was this a security issue or was this an issue of DeFi as a whole?
Yeah, that's a great question, Jessica. I think we had a sort of a moment of crisis in DeFi land, if I can use that term, because as you know, we've had enough rug pulls in 2022. The collective number is, just the DeFi alone is close to about $1.4 billion. And 2022 saw a massive decline, both in terms of the ripple effect of just the technical hacks and the 3AC and FTX that blew up, had a collective impact at the magnitude of almost about 60% of the total valuation that was taken away because of this ripple effect of people losing faith and losing confidence, leading to more fraud, leading to more withdrawals. And it was an interesting moment in time where I've labeled that a contagion of incompetence, because things were just all over the map. And while things begin to stabilize in the lion's share of 2023, we begin to see some solid projects which had longevity, which were there for some time. Technically, again, I mentioned earlier, I focus now on technical maturation to see how long you've been in business and what are the challenges you've gone through and what is the maturity of your stack that's trying to, be the foundation of the next generation of financial system. So in that context, projects like Curve, which essentially is a stablecoin exchange at the center of Ethereum's DeFi ecosystem, along with the likes of Aave and Uniswap, which is again a lending protocol and a decentralized exchange, collectively these projects sort of are mimicking what we see in our world as a financial institution that's lending, and you have investment banking, you have exchanges. They are sort of the digital analog of what is happening in the real world. So to me, that's super interesting, because the friction that's in the world that I work in on a daily basis and trying to modernize the financial infrastructure, the projects like Curve and Aave and Uniswap have made that just a breeze, reducing friction, providing transparency, and so on and so forth. But there was a moment of crisis when we begin to question our decentralized finance projects or DeFi projects. Are they truly decentralized? Are we relying on certain founders who have not just enormous access to the governance tokens, which was in question, but is that truly decentralized? Or are we relying upon the underlying infrastructure, which is Ethereum, to be decentralized, and everything else on top is a centralized system? And so the actual challenge was something called a reentrancy bug, which is a common bug that allows an attacker to trick a smart contract by making a repeated call to a protocol. So essentially, it's like you depositing it and then sending a call to steal an asset, and you can recursively keep sending the call. And because of that flaw in the code at a assembly level, and I may be getting too technical here, Jessica, but the whole idea there is that there was a flaw in a system that somebody actually had to sort of peel the layers of onion to really understand that bug and exploit that bug to be able to send this recursive calls to constantly withdraw funds. And that was the challenge that happened. And by the time this was realized, I think 73 million worth of tokens were gone. So one, it was a technical challenge. It was a technical bug. Mm-hmm. And second thing was that it led to a ripple effect, like most financial systems, which are inextricably linked, go through, where you have withdrawals and you have folks who are trying to contain the contagion by liquidating assets or finding other safer haven. Exactly what happens in the financial markets when you have equity challenges. People move to bonds and people move to other instruments that provide a safe haven. There was a whole lot of conversation. And what's interesting about this is that at a human level, Jessica, that while this was a DeFi bug and it was all happening in code, all happening in real time, this was detected almost instantly. You had the community come together, and you had the white hat sort of folks who were trying to retrieve some of the funds, or actually use the same bug to extract in a fashion to protect the assets as opposed to stealing them. But the founders of various protocols, that includes the founder of Curve, Aave, they all came together to figure out a plan to mitigate and pause the risk. And so you had some, projects like Alchemix, which were also affected, and you had Aave, which was affected. Some of them came together to sort of, help out Curve and its founder to be able to preserve the value and preserve the token and its liquidity in those liquid markets. And that to me was still a human element, that you still have individuals who are able to make this decision, and there were a handful of them. And then I go back to questioning the viability of DeFi. Is it truly decentralized finance? Because retail is still not in the capacity to make and these decisions or have visibility of the behind the doors decision making that's happening, which is the entire reason why we got into this. I mean, the reason why crypto exists, the reason why Bitcoin came into existence is to be able to provide an egalitarian platform and not just have a few make decision on behalf of the larger ecosystem. And at the end of the day, if this system begins to mimic like our existing financial system, where just a few handful of individuals get to make a decision in retail, which is individuals like me and you at the other end either don't have access to the platform or access to decision making, then what have we really solved? Are we simply digitizing the existing financial system? And so that is the question that we all are beginning to respond to. And again, that's why I'm focusing on technical maturation to see what else can we do at a protocol level so this doesn't happen again, but also that there is a certain level of hardening that we need to do from an infrastructure perspective, that when we deploy code, we are fixing everything before we actually finalize a few things. So I'll pause here to see if that made sense.
It did. You managed to explain it very well. And I think you've kind of indicated that there is a spectrum there. You've mentioned Bitcoin as being the front runner when it comes to the decentralization of why we've escaped the traditional financial structure. And then we've got DeFi, which is kind of maybe less decentralized, as you might have indicated there, than we would assume when there are issues like hacks or exploits, in which we've noted over $1 billion worth of hacks this year alone. We're halfway through 2023. Is there a risk that as we do see technology getting more advanced, we just spoke about AI, that exploits, hacks are going to be more common practice, that we're going to start to see them as regular news pop-ups on a daily occurrence? And how can me and you retail investors, how can we protect ourselves from that?
Yeah, no, I actually ask this question every single day when I'm dealing with and I'm trying to understand the ecosystem that's evolving around us, Jessica. And what's interesting is that this year, most of the fund that were impacted with this, stealing of these assets, they seem to have returned. Like lion's share of Curve Finance recouped about 73% of the funds that were stolen during the hack, which again, was a lion's share of the funds that came back to the pool. And we see this again and again in most sort of vulnerabilities that are exposed, and you find a hack and eventually you find that transparency, which is a strength of technology that we know. The wallets and the community comes together to say if these wallets are impacted, then we will pause any redemption from these wallets, which again, to me, is censorship resistance, which is big ethos of the industry per se. But the question there is that because of the transparency and application of course, AI, you're able to detect these things on time. It's almost real time. You're able to take corrective action as opposed to the old world. In old world, oftentimes we didn't know things happen until 2 or 3 months down the line. And then everything would come undone, something like Bernie Madoff, which took years for it to actually surface to say, hey, this fraud was happening. It's not the case with crypto per se. And in most cases, the intellectual sort of individuals and the folks who are adept with technology are taking the steps to either provide a white hat, which is more ethical hacking to understand these challenges. And then even the folks who are doing this for nefarious purposes eventually end up returning the funds because there's enough technology to be able to isolate and determine the wallets and potentially the systems that are behind the wallets. That to me is getting better, I think, from that perspective. So I think it's all good from that point of view. And as we have access to more technology, more processing, especially around artificial intelligence, then we are able to do interesting things like fraud detection and prevention. We're able to do smart contract automation. So using code to analyze any vulnerabilities, I think, is one of the areas that I've listed in one of the articles that I wrote. And eventually looking into decentralized credit risk analysis, that all these systems, Jessica, are all sort of independent islands, even though they happen to be on the same network. Can we apply AI to be able to evaluate and analyze the various wallets who are involved in transactions and their risks that they impose? And that will make the system better because now you have more transparency and generally you see a reduced theft spectrum and theft, the risk vectors go down when you have more transparency in the system and it's backed by, with tech, I think.
And you've absolutely boosted some optimism there in the DeFi space. We saw a lot of blood in the markets when it comes to Celsius and FTX last year. So I think what your words of wisdom there when it comes to DeFi absolutely were needed from a lot of people. Let's launch into some possibly more centralized or industry-led cryptocurrency news topics that we saw. So I'll start with PayPal because this has been quite an interesting one. Mixed consensus on the cryptocurrency grounds. So we saw PayPal launch their new stablecoin, PYUSD, on the Ethereum network. It did actually grab the attention of lawmakers as well. So Representative Maxine Walters from the US House of Financial Service Committee, she referred to it having an absence of federal oversight. So I'd like to take your opinion on what you think of PYUSD. Is it needed? Is it scalable? Is it safe? What was your thoughts?
Yeah. So first, let me just opine on PYUSD and then eventually stablecoin ecosystem, and then we'll move towards the congressional actions and Maxine Waters. I think there's a meme that's going around that Maxine Waters is blowing kisses to FTX, and now she's questioning PayPal, which is a regulated financial institution per se. But in general, stablecoins provide a really important function to crypto industry. And if you look at last year alone, stablecoins were the most traded digital asset in the entire ecosystem. There was $7 trillion worth of stablecoins that were traded. And there are close to about $180 billion worth of stablecoins. So you can imagine the velocity of transactions that these stablecoins are being used to provide fungibility, which is a medium of exchange mechanism for all crypto asset. It is also an instrument that allows for the liquidity from the real world, which is me and you having a bank account and having dirhams or dollars or pounds and converting them into a digital equivalent of them and then using them to be able to buy and sell and exchange assets in the crypto ecosystem. So it provides a bridging capability to that ecosystem. And so the dominant players in the industry, as you know, many of them came and went, but USDC stuck, which is Circle stablecoin. And then you have Tether, which had all kinds of sort of controversies around it, but now they are probably one of the largest treasury holders ahead of many countries combined, as you have heard lately, to be able to ensure that they have the collateral that stabilizes the stablecoin, hence the term stablecoin, to provide a one-to-one mapping. So $1 equals one stablecoin. And to provide that pegging, there are all kinds of techniques that the industry has adopted. So stablecoin is a really important aspect. If you look at the genesis of why it came into existence, is to be able to ensure that we're able to exchange this asset for other crypto assets and move liquidity from our real world into the crypto world, which is much needed. PayPal, and actually when I was at IBM, we worked as in consultative capacity with them and figuring out the technology, the risks. And at the time, this is pre-COVID. So when COVID hit, as you know, the entire payment industry took a pause because of pandemic and pandemic-led reduction in payment systems, and that led to all kinds of business challenges. But they always had this on the plan. And so,
how early, sorry to interrupt, how early was the first time that you heard PayPal had the idea of getting kind of into the blockchain stablecoin realm?
So if you recall, PayPal announced the ability for you to host the Litecoin and Bitcoin and Ether in their wallets.
Yeah.
It is around that time that we begin to socialize the idea of stablecoins in the same wallet. And the idea was that if you have a PayPal wallet or you have a Venmo wallet, or which is the PayPal company, then ability for you to hold different kinds of instruments in the same wallet, whether it's Bitcoin, whether it's Ether, whether it's Litecoin, and in future, other coins that have some regulatory clarity could show up in your wallet and stablecoin. And you could then have a choice, Jessica, to use any one of them as payment instruments. So if you're buying a coffee and you don't want to use your stablecoins, you want to use Bitcoin, you're free to do that. That is the entire vision of and to me, it's really a fundamental use case, which is why Bitcoin was born in the first place, is to solve a payment problem, the ability for us to be able to move money between individuals and businesses, and between businesses themselves around the world. So the beauty of PayPal entering the space, which I think is such a positive news, that despite all the FUD and all the congressional chatter and the legal and regulatory challenges from various alphabet soup of regulatory agencies around the world, you see these pockets of innovation, pockets of adaptation to the industry, the innovation the crypto industry has to offer, whether it's ETFs or whether it's tokenization of money market funds, or whether it's, so this is all coming together. And PayPal, unlike the crypto, which is still in tens and millions of active users, PayPal actually has 400 million plus active wallets around the world. And while the PYUSD is only available in the US today, I think there's a demand, as you may have seen from the likes of Argentina and many of the economies who still are viewing US dollar, despite all the geopolitical challenges of the US dollar hegemony, again, in the region that you're in, and paying it for commodities. But there is still a appetite for many consumers around the world who are dealing with hyperinflation, and that's eating into their earnings and their ability to be able to preserve the value of their savings. Imagine if they could convert their currencies into US dollar, and suddenly you see the demand of US dollar spike up. And because PayPal is in that business, and PayPal is in 170 plus different countries, I can see that if USDC stablecoin becomes, then ability for you to be able to move, your stablecoins or USD around the world becomes a lot more simpler. And imagine doing a small business trying to make, a penny in Argentina or Chile, should be able to accept your US dollars without actually having to go through the various hops that we take today and the rent that we pay for those hops. I think this is such a positive thing from that perspective, because it's still a closed system. And it's safe, in my opinion, because one, it's a regulated institution. They are bound by a bunch of regulations because they are maintaining, like Venmo maintains a closed loop system. So they have to maintain certain reserves, and they have to provide audit function to those reserves. And this one-to-one mapping, I think they certainly have the apparatus to provide that level of, assured delivery of these proof of reserves that the industry is seeking, to ensure that, if there are 1 million stable coins, there's $1 million that backs that stable coin, and it maintains that peg for good. So I'll pause here again. I know it was a long rant, but hopefully that made sense.
No, it was excellent. And I agree with you. I think when everyone initially that were looking to build in the blockchain and cryptocurrency space, they would look at the likes of Western Union and say the fees are outrageous for people that are looking to send money cross-border. Cryptocurrency is the answer. But then when looking at scalability, solutions that, as you've mentioned, already have 400 million users, it does seem like an excellent alternative and an option and a gateway for a lot of people. Is price going to be an issue, being it based on Ethereum with gas fees, or is that something where we'll look at PayPal having more of a stable approach to how to send money?
Yeah, no, that's a great question too. And I think on the long run, right? So this is why I use the word closed loop system, that not every transaction hits the blockchain per se. And of course, this past week, besides the curve, there's been a lot of memes and conversation, Jessica, where a lot of failed layer ones have converted into layer 2 protocols. So there's a whole wave of things that happened last week where a lot of layer 1 protocols just gave up on the layer 1 dreams and said, let's be a layer 2 protocol. And the intention of layer 2 protocol, which I think we'll briefly touch upon, CoinBase's Base, which is a recent one. And then you have a whole slew of layer 2 on Ethereum that have, like the Arboretum one and the optimistic rollup, the Optimum and the ZK Sync and Loopring. And so you have a slew of layer 2 whose mere existence is really to reduce the cost of transaction processing. So these are ecosystems that are evolving as a layer 2 protocols to reduce the fees, to reduce the cost, provide scalability, provide additional security, which is what Polygon is doing. So a whole element of technical maturation, as I mentioned early on, is being adopted to ensure that the cost of transaction goes down. But PayPal doesn't have to process every single transaction to the blockchain, because remember, it's a closed system. So if you're on PayPal and I'm on PayPal and I'm sending you money, Jessica, all PayPal has to do is update its ledgers. That transaction doesn't have to go to Ethereum, unless you choose to move it to Ethereum ecosystem, which PYUSD can. It's only then you're paying a fee, and I'm pretty positive that fee will be passed on to the end user.
So in your view, good news for adoption. This is a big thumbs up.
Fantastic.
For 2023.
And they will start with the US because we have, again, it's a closed system, so they have enough ammunition to make the arguments with the likes of Maxine Waters to assure the regulation and the government that everything is okay and it doesn't affect your payment systems and payment infrastructures. And more importantly, I think the reason why you find regulators around the world question stablecoin, because there's a whole element of money supply. So as you know, central banks deal with base money supply, which is called M0, and then you have the credit, and you have that credit is lend. And so you have various layers of which is the sum total of all the money that's outstanding. And the base layer, the base supply, is controlled by central government. And one fear that most regulators and lawmakers have is, do stable coins increase money supply? And increasing money supply leads to, again, things like inflation, which we've seen with all the stimulus that was pumped in the US economy during COVID. We are still reeling from the impact of that. And that essentially is increasing money supply or velocity. So if suddenly stablecoin becomes a most transacted instrument, then that's a great thing for the economy because it shows utility of the asset. But the two things that control the value of a currency is the money supply and the velocity. There's a whole equation, PV equals MQ, which we don't want to get into this on this call, which essentially dictates as to how the economy functions. And I think that's the concern. They just simply want to make sure that you're not increasing the money supply because that's a function of central bank and not of non-banking financial institution, for instance.
Mm-hmm. So you mentioned layer twos there. So I think we'll jump now from PayPal. As you mentioned, that's a big potential industry driver. So we'll have to wait and see once they open up PYUSD to wider than the United States, how that looks when it comes to appetite in the wider market. It's going to be really, really interesting to see how that goes. Base was launched this week with Coinbase, and we did review some of the numbers that came out when it comes to active users. So on the second day of Coinbase's layer 2 base coming out, 136 daily users. So Jesse Pollack, who's overseeing Base, has said that it's open for builders only. Were you surprised at the number base that we did see? And also when it comes to this being a new platform for Web3 adoption, another layer 2 on the market, is it needed right now? How is it going to contribute? What's your take?
Yeah, no, I think one, that's also a significant announcement, and coming from Coinbase, which is a quite sound institution because they've been, again, it's a public company and they manage one of the world's, biggest exchanges after Binance, of course. And it's very sound management, very sound thinking, a lot of smart people. Some of them I personally know because they have been heads down in figuring this industry out. So I think it's a very positive. And I think Base is built on Optimism, which is a layer 2 protocol. So think of it as it's an offshoot taking existing layer 2 and bringing another layer 2 with some specialization. So think of layer 2 as an ecosystem, like cities. If I can give layer 1 a nation state status, think of layer 2 as cities that are attracting economies, just like New York and Tokyo attract certain set of players as opposed to, let's say, Mumbai and San Francisco, for instance. So from that perspective, one, it's great. Second thing is, I'm not surprised to see that number, only because one aspect of layer 2 evaluation is two things, right? One is the number of transactions, which is a metric that's used for any single layer 1, layer 2, or any protocol that's built upon on these layers. But there's also an element of TVL, the total value locked. And I'm not surprised because Coinbase in the US alone serves like 100 million people, which is like almost a little over 1/3 of the US population is using Coinbase. So they certainly have the institutional space with prime and lending and custody of these assets. They have an exchange. And one reason why they had to get the layer 2 protocol is because it's growth. At the end of the day, if you look at your existing business, which is reliant upon institutional side, which is Coinbase Prime and Coinbase Lending and Coinbase sort of custody, meant for institutions, can only grow so much because you only have so many institutions. And then you have the exchange, which can also have so much growth potential because it's limited by regulation. As you know, there's a lot of FUD in the US. Being a US company, they have to adhere to US regulation. And we all are aware of all the challenges they're having with SEC. And again, in terms of the lawsuits and their ability to be able to fight. In that climate, they need a growth potential. And base to them is that massive growth to say, we are providing you an infrastructure that you become a vertically integrated one-stop shop for you to develop your projects, list your tokens. And while we are providing you with the infrastructure, we'll not be liable for your project. So all these amazing ecosystem growth that you have seen in such a short amount of time is coming from, one, the branding. Two, is built upon the optimistic rollup, which is, again, the technology itself is meant to reduce this massive cost of transaction processing, and it's tied to Ethereum ecosystem. So it's piggybacking on all the projects that are on various offshoot of Ethereum ecosystem. It's easy to move them into this layer 2 protocol, and taking advantage of the broader ecosystem that Coinbase has to offer, namely, again, the custody, the prime brokerage, the exchanges, and the listing process. I think it gives them a complete sort of, a massive exponential growth in not just listing assets and selling assets and financialization of these tokenized assets, but it also gives them the ability to start encroaching into the developer ecosystem, which Coinbase has not done that yet. So that's my take on this, which I think is also very positive and very, I would say, forward-thinking approach, that they want to continue finding vectors of growth. And this becomes this base announcement gives them at least a few hundred vectors to grow in different directions, because they now have development control on providing capabilities and making this base more attractive layers for builders to build, if that makes sense.
And it seems like it's the perfect time for it now. It seems like this is definitely a bear build period of market cycle. Jesse Pollock has spoken out saying that there's nearly 100 dApps that are waiting and ready for deployment on Base Network. Is it also the case that we're seeing a lot of maybe US builders that are saying, Coinbase has a huge presence in the US. They obviously have been challenging the SEC for how to move forward. It actually provides almost a regulatory umbrella, a little bit of additional security and safety to go this avenue? Or is that not something that's hand in hand right now?
So I think there's a little bit of the branding effort, that it's a well-known brand. People trust it, and the trust comes with, the ability for you to build this. Except that I think there's Jesse Pollock, or even the narrative behind the base, was that the reason why Coinbase is not getting into the building business, even though they're building the layer 2 protocol, is because they don't want the base or base token to be, they want it to be a utility. So this whole notion of true sense of decentralization and what does token represent. And if they begin to start building businesses or dApps on top of them, then they get into this gray area that they've been fighting with SEC for quite some time. Mm-hmm. So they made it quite clear that they want to be only in that layer 2 business and allowing the businesses to grow. So businesses are still responsible for their own proof points of discerning between the type of instrument, whether it's a commodity or whether it's security, whether it's a true utility, which has the clarity, which Bitcoin and Ether has a clarity to a certain extent. And Base or Coinbase want to steer clear of that definition that the builders bring. But from a builder's perspective, they do get a end-to-end and a trusted brand to deal with. That if you're accepted on Base, it's like you have your app being accepted by Apple App Store and Android, are two dominant platforms. It opens up a lot of opportunities and distribution mechanism. And I view this as an attractive platform for any builders to build, because it's like submitting your app to the App Store, and it gives you a massive distribution and other adjunct services that you may not have on any other platform, for instance.
Yeah, as you mentioned there, the audience pool in the United States is enormous. So it will definitely be interesting to see how that plays out in the next 6 months or so. So to finally wrap it up, Nitin, we have covered a wide range of topics today, but I do always want to end touching CBDCs with you and just having a look through what we are seeing in the space at the moment. I had a look through some of your recent talks and panels. I do have to reference, you had a fantastic discussion, a fireside chat with Sergey Nazarov from Chainlink. I will leave the link in the description if anyone will like to watch. And you discussed the future of financial markets. And there was one element that was particularly interesting, and it was, could we start to see banks actually roll out and make their own DeFi products, or are we going down this avenue of more of a CBDC route? So I think first of all, to open the floor with that question, and then we'll dive in a little bit more into what the industry holds for the likes of me and you, retail investors.
Yeah, and that's a great question. Just kind of have a long-winded response, like always, because it's loaded with a lot of vectors that we can explore. But that was a super interesting chat that I had with Consensus, which was in my hometown, in Austin, Texas. So from traditional finance, which is, I work at State Street, one of the oldest bank in the world. And one of the things that we explore are Rails, which is the existing infrastructure, right? So before we get into DeFi and go into all the advanced topics that we discussed with Curve and with Uniswap and Aave, and each of them actually have an institutional offshoot of how they want to address with traditional finance. The challenge is, which is what I'm dealing with day in, day out, is how do we modernize the infrastructure that's capable of handling tokenized fiat? So largely our entire financial system relies upon this massive pipes that send messages back and forth. And we take those messages and put them into our ledgers. And that's how transactions are done at a very broad level. Suddenly now you have tokenized assets, whether it's tokenized fiat, and I broadly categorize tokenized fiat as central bank digital currencies, which is issued by central bank, stablecoins issued by a non-banking or banking financial institution, which promises one-to-one peg. And then there's a new category that has emerged in the last 2 years, which is tokenized deposits, namely from JP Morgan Chase, to remove this whole money supply conversation we had, Jessica, where it's nothing but a deposit. And if it's tokenized and I'm moving the deposit, I'm not changing money supply. I'm simply moving your deposit from one bank to another bank. And because these are deposits tokenized, but all these are flavors of cash. All these are flavors of money that the various institutions are trying to deal with. And the reason that that's important, Jessica, is because money or fiat, which is dollar, pounds, euro, rupees, they provide fungibility. They provide a medium of exchange to every asset class. So when you're buying and selling your securities, your stocks and your bonds, you are in return getting money in your account as a part of the proceeds from the sales that you're of these assets. And that there's a duality to every transaction, right? And that's why this notion of settlement, which is such a sanctimonious process in financial services industry, that whatever you do, you have to settle that transaction before you move on to the next one. And the settlement requires fiat. And if you're tokenizing asset classes, you have to make sure that you have to also tokenize money. Otherwise, you're leaving one big part of the equation untouched, and you still are plagued with the same processing overheads and inefficiencies that we are discussing in context of crypto and digital assets. That's why CBDC stablecoin tokenized fiat conversation is such an important one. And what ends up happening is that this messaging layer that we're talking about, which is Swift is one of the main sort of institutions that connects the various about 11,000 global banks and allows them to be able to provide secure messaging so they can actually transact with each other across the globe. But you also have domestic rails or real-time payment systems. All these systems today are based on these messaging infrastructure. But the moment we bring tokenized, assets to this ecosystem, you suddenly have to maintain two things. And my latest article talked about the challenges of bringing such a system to existing element is you have to make sure that your systems are able to handle tokenized assets. So with tokens comes verification validation, which is what blockchains do, your ability to custody the asset and custody different types of assets, because custody is safekeeping. As a bank, that's what banks do. They safekeep your clients' assets. And you have to do this while you're maintaining the old system, which is, again, as I mentioned, early on, it's a $471 trillion global market, and crypto is still 1 trillion. So as the bank prepare to have tokenized asset, they still have to maintain this. So having a harmonized operational framework is such an important part. And what Chainlink and Sergey and his vision is trying to do is solve that problem to be able to bring the traditional finance into the blockchain world. And what many of us, our heads down, is doing the opposite, is bringing this digital asset tokenized world into the traditional finance world. And that both are important only because both are needed for this to be simultaneously, operational while we are slowly moving the workload from the old world to the new world. I'll pause here, Jessica, because I said a lot. I just want to make sure it made sense.
It did. No, you made some excellent points. And I think one big question people wonder is this possible? Is it possible that these two worlds can live coincide together? They can live co-in-hand and we can evolve together? Or is it two separate? It sometimes feels like battles between the decentralized finance space and the TradFi space. And Nitin, you're a great example of working in between the two and almost translating both languages so that we do see some involvement in the space. But it must be a challenge at times.
It is. And I think one is political will. And second thing is understanding, because there are people in financial services industry who worked for 25, 30 years and they know what they know. And so challenges for us to be able to, one, a lot of this translation and coexistence, as you mentioned, Jessica, requires investment of people, time, technology, and funding. We are in this recessionary mindset at the moment. So a lot of banks have paused a lot of investment that actually was happening in 2020 and 21 era. So I think it's one, political will, investment that's needed to do this, and more importantly, talent. All the cool guys want to work in crypto projects, and many of us were trying to attract talent to bring this, because I think both are needed. You're limited by, again, some of these factors of talent and resource that's needed to do these things. And more importantly, forming a business case. Half the time I'm spending is figuring out what use cases make sense. How do I pitch this to regulators? Because most banks have to get regulatory approvals before they do any of these changes, which, as you know, is a Herculean task per se. But again, I'm not frazzled by that. I think if we have the right tech and we're able to build the right tech, and you're able to see the proof points, and it's then becomes a bit more easier to convince regulators. I think the challenge the industry has done is they have gone to regulators upfront, and even with small POCs. And I think we should figure this out at a production grade level work, which requires time and talent, I think.
So almost have a kind of small sandbox production rollout first to ensure that it works before going straight to the regulators. Is something that you think actually for adoption to move faster?
Yeah, I think Singapore has Project Guardian, which has done exactly that. Jessica, I think Bank of England is contemplating this sandbox, and they recently has proposed this academic advisory group, which is having all the industry leaders come together for the sandbox environment, which, again, the idea is if you operate in the sandbox environment, and it's mostly conceptual, that we're not going to throw regulatory books at you. That you're able to take risks in a limited form that doesn't impose a financial stability risk, because it's happening at a microscopic level, but it proves the point. And I think some projects in the world, Project Guardian, Project Jasper in Canada, Bank of Japan had some projects internally. They have done a fantastic job in articulating these things, and I think that has inspired. Again, Swift has been at this, even though they're at the precipice of being disrupted. If this all goes well, they have taken the approach to say, let's understand this better. PayPal has taken the approach to say, if this is disrupting our business, let's try to issue a stable coin. Let's understand this disruption so we can be part of that business and part of the solution, as opposed to standing on the sidelines and waiting for regulations to come through, I think.
And CBDCs themselves as a phrase, as something that we are expecting to see implemented across Europe, UK, US, as we've mentioned, is something that is going to be happening in the foreseeable future. For people that are in the cryptocurrency space, there is fear, there's uncertainty about what that means for them as an end individual. What would you say to some of those people that are sitting here listening to this going, oh, I don't want that. I don't want to see Fed now potentially migrate into a CBDC. I don't want to be based in the UK and have the Bank of England implement a controlled currency for me.
Yeah. So there's two schools of thought, Jessica. And I think the first school of thought is they absolutely have to do it. And I think every government has now, I think the last BIS report suggested about 81% of the world's banks are seriously down the path of exploring CBDC, in terms of it's no longer if, but when. And so, one, that's positive. But the first school of thought is they got to do it. One, because they have to provide a robust infrastructure and instrument that deals with the scale and the velocity and veracity of transactions that are needed. So millennials and the newer generation, they want faster transactions, and you cannot rely upon a day or 2 days to clear bank transaction, which is the old model. So they had to do it simply to uplift and upgrade the infrastructure to keep up with the demands of the economic system and the transaction volumes that are expected to only increase as everything around us is increasingly being digitized. And we're entering this hyper-financialization world where everything is a transaction. So they got to do that. So there's a school of thought to say, to make the sovereign fiat, which is the currency issued by the government, we need to modernize our infrastructure. So think of it as infrastructure play. And the second school of thought is, can that crypto CBDC be subjected to freezing and forfeiture requirement? That can it be forfeited by a government based on anything? And I think PayPal came into fire as you know, during COVID time, that if you have misinformation, then they could penalize you from $2,500. I think there was a time when they got massive flack for it because one, it's freedom of speech, and you have nothing to do with how I speak and what is misinformation. So who are you to impose that fine on me? The question then became is what is the implication if this is programmable money, which most likely it will be, then how much control does government have? So the Western world is more focused on privacy preservation, freezing and forfeiture requirements, and the government control on ability to freeze and forfeit your asset, especially after the geopolitical situation that we've seen lately emerge. And the second element is that, which is the Asian world is looking more towards the fact that, hey, can we address efficiency with this, which is what we've seen some experiments in China and India. Both have done their level of experiments with CBDC, and their focus is we do need to have a model that allows us to achieve the transaction finality and efficiency. So I'll pause here, Jessica, to see if that made sense.
It's such a fascinating topic, and there's so many different avenues to go down and discuss. I know that we are running short for time. So Nitin, I think we're going to have to invite you back and have a full episode on CBDCs because there's so much that I myself would love to ask, and I'm sure our viewers would love to pick your brains as well. But for now, I would like to thank you so much for your time today. It's been absolutely fantastic. We really appreciate you being so flexible with the time difference, and what a range of topics that we've covered. It's been really insightful. Thank you.
Well, thank you again for the invitation, and love to have another long chat with you on CBDC, Jessica. Have a great day ahead of you.
Well, if you would like to hear more from Nitin, and I absolutely recommend you to check out his LinkedIn blog post, I'll leave a link to all of his socials in the description box. Thank you all so much for watching. Subscribe to the channel if you haven't already. Also give this video a like if you enjoyed it, and say hello in the comments. And if you are looking to continue your crypto journey and looking for a hardware wallet or a new exchange to trade on, then our deals page is where you should go. We have discounts on wallets, trading fees, and exchange airdrops of up to $40,000, all for the viewers of this channel. So all of that is in the description box. Till then, see you all very soon.